Hello my fellow investors and welcome to the most anticipated day of the week, Tuesday, January 24th. And the reason is, take a look at all of these companies, guys, that had earnings, and I want to take a look at most of them just like I promised. And I also want to put out this video tonight as well, so I'm so terribly sorry if you do see this late at night, like around like 10 p.m. or something, but I really want to have it out just so that way you guys tomorrow can have a chance to see it, go to the timestamps of the companies that you may want to invest in, and make a determination on whether or not you may want to buy them at the current valuation or not. So we're going to take a look at some of these earnings, and when I mean by some, I mean more than just a few. And let's use discounted free cash flow to see if at the current price, even after earnings, do we still want to buy them. And of course, like always, guys, just in case I forget to mention it, none of this is financial advice. Please do your own due diligence. I highly suggest that you guys read the earnings for yourselves. Just because I'm going over it doesn't mean that you should not read it. Please read it for yourselves, as well as read further into what each company is doing, because you can lose money when it comes to investing. So for that reason, I will have all of the earnings reports linked in the description below for all of you guys to read. And of course, the discounted free cash flows are all available, as well as the other calculators as well. So with that said, let's get started with these analysis. And of course, guys, just because I have to, I'm going to start with the most anticipated out of all of these earnings, and that is none other than Microsoft. Like, I kid you not, when Microsoft had earnings, Seeking Alpha had like breaking, Microsoft announces earnings, and I'm just like, really? Microsoft is not the only one. Why are they putting this as like breaking news? Absolutely crazy. So let's actually take a look at these earnings. Now, coming over here to Seeking Alpha's earnings summary, we can see that unfortunately they do not have it updated yet, but we can see that the EPS normalized estimate is $2.31, EPS gap estimate $2.27, revenue estimate $53.15 billion. Now, if we actually come over here, we already have articles about this. Microsoft non-GAAP EPS $2.32 beats by 1 penny. Revenue of $52.7 billion misses by $450 million. So unfortunately, we do not know what the GAAP revenue is. However, for the non-GAAP, you can see that they did beat it by 1 penny. Again, it was estimated at $2.31. So let's actually come over here, guys, and read their earnings report. We got over here earnings release for fiscal year 2023 Q2. So yeah, Microsoft's earnings releases are kind of weird. Actually, their fiscal year ends in June, so just keep that in mind. But we got over here, guys, revenue was $52.7 billion, an increase of 2%. Operating income $20.4 billion, which is GAAP, and $21.6 billion non-GAAP, and decreased 8% and 3% respectively. Interesting. When it came to both the GAAP and the non-GAAP, they both decreased 8 and 3%. Net income was $16.4 billion GAAP and $17.4 billion non-GAAP, decreased 12% and 7% respectively. Diluted earnings per share was $2.20 GAAP and $2.32 non-GAAP, decreased 11% and 6% respectively. This is not looking good, like straight up. Like, so far, just of reading that's not looking that good at all. So now let's actually come over here and see what the CEO had to say. Quote, "The next major wave of computing is being born." That's pretty over dramatic. As Microsoft Cloud turns into the world's most advanced AI models into new computing platforms, said Satya Nadella, chairman and chief executive officer of Microsoft. "We are committed to helping our customers use our platforms and tools to do more with less today and innovate for the future in the new era of AI. We are focused on operational excellence as we continue to invest to drive growth." Microsoft Cloud revenue was $27.1 billion, up a whopping 22%, up 29% on a constant currency year over year, as our commercial offerings continue to drive value for our customers, said Amy Hood, executive vice president and chief financial officer of Microsoft. And as I just read right there, guys, that right here, this reason, Microsoft Cloud 22% up, is the reason why Microsoft just ripped aftermarket. Literally, they did not do that good, right? They beat earnings by 1 penny and they missed revenue. Yet, because of this, Microsoft Cloud, I want to show you guys how much their share price has increased after market, and it's only because of that. It's absolutely ridiculous. Now, let's come over here and compare some of these numbers to what they were back in 2021. So we got over here 2022, as reported, let me actually make this a little bit bigger so that way you guys can see. So we got over here, as reported, $52.7 billion in 2022 GAAP, and then in 2021, $51.7 billion. So that was an increase of like $1 billion overall. Okay, when it comes into the operating income, it actually went down 22.2 billion in 2021 as opposed to 20.4 billion in 2022. That is a difference of $1.2 billion. And when it came to the revenue, it was pretty much the same, so they pretty much just put it like at zero. When it comes to the net income, $18.76 billion in 2021 to $16.4 billion in 2022. That is another decrease of $946 million. And when it comes to the diluted earnings per share, $2.48 to $2.20. So that also went down. That is actually fairly surprising overall. And coming further down here, guys, we got the business highlights. Revenue and productivity and business processes was $17 billion, increased 7%, up 13% in constant currency, with the following businesses highlights. And they go on to say the following businesses highlights. I'm not going to go through them. You guys could read them for yourselves. Revenue in intelligent cloud was $21 billion, which is an increase by 18%. Revenue in more personal computing was $14 billion, decreased 19%, with the following business highlight. So that's it, fairly interesting. When it comes to PCs, their revenue is actually crashing. So they're making majority of their income when it comes to, of course, the intelligent cloud as well as the productivity and business processes. Aside from that, guys, they're definitely losing a lot of, I wouldn't say a lot of money. Well, actually, 19% is pretty big, but they're losing a significant amount of money when it comes to PC-related things. Really, really interesting to see. Now, unfortunately, Business Outlook. Microsoft will provide forward-looking guidance in connection with its quarterly earnings announcement on its earnings conference call and webcast. So they don't really mention this here, but you know, I guess we'll find out about this when this releases, right? People will make articles about this. But if we actually come down here, you can actually see segment revenue constant currency reconciliation. And we got here productivity and business process, intelligent cloud, and personal computing. Pretty much what we saw up there. It's just a nice compact way to see it. And comparing this, guys, to 2021, we can see that in 2021 it was 15.9 billion, let's just say 16 billion for the productivity and business processes, and in 2022 was 17 billion, again increase of 7%. Intelligent cloud, it went from 18.3 billion to 21.51 billion, increase of 18%. And more personal computing, it went down from 17.5 billion to 14.2 billion dollars. So now let's actually come over here into the calculator and let's take a look at Microsoft. We got the ticker symbol for MSFT, market cap of $1.8 billion, a PE of 26.08 with a current share price of $242.04. And looking at this on the 1 year, guys, we could see that, well, they're actually down a significant amount, 18.33%. Year to date, though, they're up. Actually, not that much. I was expecting a lot more. 1.03%. Now, I did say that their current share price is like $242. However, that's as of 4 o'clock when market closed. As of post-market, when these earnings came out, take a look at this, guys. Their share price actually came down for some reason. Wow. Okay, so that's fairly surprising because you could see that they're only up 0.11%. Yet, I kid you not, a couple hours ago, I really kid you not, a couple hours ago, I'm talking about like 5 o'clock, 4:30, this thing was up 4%. This thing was up 4%, and now it's fallen down a significant amount. So okay, I pretty much take that back for all those things I just said of like, oh my god, the share price is so high. Okay, never mind then. 52-week ranges of $213.43 to almost $316. So not 52-week lows, but it is on the lower end, so this might actually serve itself as a pretty good opportunity to buy this company. Coming back into the calculator, they do pay out an annual dividend of $2.72, which is a yield, actually it's actually really small, of only 1.12%, a payout ratio of 27.37, a 5-year CAGR of 9.82 with 18 consecutive years of dividend payment. Ex-dividend day is actually coming up on the 15th of February, and they do pay out on the 9th of March, and of course they do pay their dividends quarterly. Based off of the current shares outstanding, guys, and this $2.72 in annual dividends, they pay out $20.3 billion. As of their 5-year average free cash flow, after this $20.3 billion is paid out, which is a massive amount, they're still left with $27.1 billion in their 5-year average free cash flow, which is insane. Last year's free cash flow, if we do the exact same math, it is, well, yeah, it's more. It's a lot more actually. $44.87 billion. Insanity, absolutely crazy. And take a look at these payout ratios in regards to the free cash flow, guys. Last year's free cash flow 31.13, and as of the 5-year average 42.8. Absolutely crazy. They have more than enough cash to not only pay out this dividend but continue growing it, which is just mind-boggling. So now let's actually take a look at some fundamentals. Net income 16.57 billion to 1 year ago of $72.74 billion. Increase of 339%. Guys, what's amazing about this is that it's consistently increasing. There has been 2 instances where they went up a little bit more than what I would like. 5 years ago to 4 years ago, and then from 3 years ago to 2 years ago. That's it. So for that reason, I have to give this thing like a 90%. That's absolutely gorgeous. And it continues with the free cash flow. 5 years ago of 32.25 billion to 1 year ago of 65.15 billion. Increase of 102% with an average of $47.4 billion. This one looks even better than that of the net income. I have to give this a 100%. This is absolutely gorgeous. Looking at the revenue, it's just, I mean, this thing just prints money, right? This thing literally just prints money. 5 years ago of 110.36 billion to 1 year ago of almost $200 billion. What? Increase of almost 80%. Guys, not a single time did they go down, and there isn't really any outliers here. I have to give this once again a 100%. I mean, yeah, you already know where this one's going, right? Total assets minus total liabilities. Every single year has been positive and continuously increasing. As of today, they're up to $173.56 billion in this difference. And you can see this looks beautiful as well. Now, the single outlier, that a single time that they go down, it's just gorgeous. Average total assets is $329 billion. Average liabilities is $188.71 billion. And doing this difference, they still have left, guys, $140.5 billion. I mean, this is another hundo right over here. Absolutely crazy. Now, looking at the cash flow minus liabilities, this is insane as well. Within the past 5 years, they have pretty much kind of consistently brought it closer and closer to zero. The one time when they didn't was 5 years ago to 4 years ago, where they increased it by around like $2 billion. That's about it. The following year, from 4 to 3 years ago, they bought back, getting closer to zero. Then from 3 to 2, they did the same. And then from 2 to 1, they did the same. Average cash flow minus the average total liabilities, we get negative $139.3 billion, which is higher than the value from 1 year ago. So guys, I have to give this like a 95%. This is amazing. Looking now at the shares outstanding, silent killer when it comes to investing. But luckily for everybody, Microsoft does not kill you, which is really, really good to see. 5 years ago of 7.7 billion shares to today of 7.45 billion shares, or 7.46 billion shares. That is a decrease on the 5 year of almost 3%, to be exact 2.87%. And from the previous year to the current year, it is a buyback of 0.09%. The good thing about this is that not a single year did they increase a little bit. In fact, this is very, very consistent. Like very, very consistent. Like that trend line is on top of that line, or on top of these graphs every single time, guys. Absolutely incredible. I mean, 100%. This is just 100%. Absolutely crazy. Cash and equivalents, they currently hold $23 billion with an average of $14.65 billion. Guys, this is just an insane company. Are you ready for these grades? We gave the net income a 90%, free cash flow 100%, revenue 100%, assets minus liabilities 100%, cash flow minus liabilities 95%, and the shares outstanding of 100%. A 98! I think this is the highest I have ever given any company ever. This is insane. A 98%, guys. Yeah, it's just that good. There really isn't anything else to say about this company. I mean, come on. But now let us come over here and see whether or not this is a good buy right now. Because it was a lot higher than 242 just a couple minutes ago. Now it's not. So very, very interesting. Now, I already have everything already in here, mainly because I just kind of want to run through this. I got a lot of stuff to do. So let's make revenue growth assumptions of 6, 7, and 8%, and the predicted share buyback of 1, 2, and 3%. I'm getting these from Seeking Alpha's revenue growth forward, 12.55%. I personally don't believe that they'll do 12.55% in the next 4 years, so I'm being very conservative and I'm cutting it in half, and I'm saying from a highest assumption of 8%. And of course, the projected share buyback, they have been doing a little bit less than 3%, so I said 1, 2, and 3%. With this, guys, we get the target share prices of $135.24 to $147.71, not adjusting for debt. Now, adjusting for debt, this shoots up massively. They don't have any debt. Incredible. Adjusting for debt, $273.58 to almost $300 at $298.58. With a margin of safety of 5, 10, and 15%, this is between $232.54 to $283.65. So here we have a situation that at the current price, guys, this is hitting pretty much every single assumption adjusting for debt, and even majority of all margins of safety, all except for one, and that is the lowest assumption, the 15% margin of safety. As it currently stands, this is looking like an amazing buy right now. Believe it or not, I really wasn't expecting this. I really was not. Yeah, this is actually a pretty decent buy as it currently stands. And of course, we cannot neglect this dividend because it does have a pretty good CAGR, in my personal opinion, and they have the cash flow to continue to increase it, putting in $5,725. This nets us an annual dividend of $64.34. Not that big, but guys, it's Microsoft. We're talking about the company that in 2016, they went from, I kid you not, $80 stock price, right? 315 at the peak in the 52-week highs. Incredible, right? Absolutely incredible. It's a great time to buy it right now according to discounted free cash flow. So do with that information as you will. All in all, Microsoft is one of my favorite companies to date, and I mean, I just proved why, right? So let's get on to the next company, and that is, and now guys, we are over here at the second company that had earnings, and this one they had it pre-market, and that is none other than Verizon. Now, I own this company. I mean, I own Microsoft too, but the reason why I'm telling you guys that I own Verizon is because, well, I'm going to be fully honest with you guys. Verizon is one of my top holdings, and unfortunately, this is one of the companies that I am severely down. Chevron is the one I have my highest amount, and it's by far the biggest gainers. However, Verizon is actually the opposite of that end. It is my biggest loser. In fact, it's doing so bad right now, guys, that out of the 271 shares that I hold of Verizon, I am down $3,433. I have invested $14,000, almost $14,400 into this company, and I am down $3,433. Now, they are paying me a very good quarterly dividend of $176.83, but I just wanted to be very, very transparent with you guys that when it comes to Verizon, I mean, Microsoft too, but Verizon, it is technically my second biggest holding, and it is the one I've lost the most. Can't be all winners, but they're at least paying me a pretty good solid dividend overall. Just wanted to be transparent with you guys. So now taking a look at Seeking Alpha's earnings summary, we got EPS normalized actual came in at $1.19. That was in line. EPS GAAP actual $1.56, which is a beat by 39 cents. Revenue came in at $35.25 billion, which was a beat by $107.5 million. Overall, not bad when it comes to Verizon. So now let us come into, guys, Verizon's earnings report. We got over here strong wireless service revenue growth highlights Verizon fourth quarter and 2022 results. Company enters 2023 with momentum in wireless mobility and wireless broadband. Now about that, I'm actually going to show you guys an article in just 1 second that kind of tells the complete opposite of this, and I'm gonna tell you guys exactly what happened with Verizon when the earnings actually came out, because it was a roller coaster. It really was. But regardless, let's come over here. We got 2022 highlights. Full year 2022 earnings per share $5.06 compared to $5.32 in 2021, so that was lower than it was 1 year ago. Adjusted EPS excluding special items of $5.18 compared to 2021 with adjusted EPS of $5.50. Total operating revenue $136.8 billion in full year 2022, up 2.4% year over year, which is really good to see. Now for Q4 highlights. We got $1.56 EPS compared to $1.11 in the fourth quarter of 2021, so that was good. They did better than Q4 2021. Adjusted EPS excluding special items of $1.19 compared with $1.33, so that one came down in fourth quarter of 2021. Total operating revenue of $35.3 billion, an increase of 3.5% from fourth quarter 2021. Net income of $6.7 billion, an increase of 41.4%. What? That's insane. Net income increased 41.4% from the fourth quarter of 2021. What? Wow, okay, and adjusted EBITDA of $11.7 billion, down 0.2% year over year. Okay, so that isn't even that bad. Now, I want to come over here, guys, and take a look at some of these, well, their segments, honestly. We got total wireless service revenue of $18.8 billion, which was an increase of 5.9% year over year. Postpaid phone net additions of 217,000 and retail postpaid net addition of 1.4 million, which was the best single quarter performance in 7 years. Full year 2022 retail postpaid net additions were 2.61 million, an increase of 23% from the full year of 2021. This success was driven by strong fixed wireless momentum, tablet and wearables adoptions, and sequential improvement in phone net additions. Total retail postpaid churn of 1.14% and retail postpaid phone churn of 0.89%. And when it comes to the total broadband, we got total broadband net additions of 416,000, was the best total broadband performance in over a decade, reflecting a strong demand for Fios and fixed wireless products. This result included 379,000 of fixed wireless net additions, an increase of 37,000 fixed wireless net additions from third quarter 2022. The company reported sequential quarterly net additions growth and fixed wireless throughout 2022. Full year 2022 total broadband net additions were 1.3 million, an increase of 409,000 total broadband net additions in full year 2021. Wow, that was a mouthful. And they also mentioned 59,000 Fios internet net additions. This is all sounding really, really good overall, not gonna lie. Now, I want to take a look at what the CEO had to say about this. I am not going to read this whole entire thing. I just want to read right here. We believe in operational expectations and financial targets that we set in the second half of 2022. Said Verizon Chairman and CEO Hans Vestberg, we are rapidly building out our C-band spectrum with the most aggressive network deployment in our company's history, and we are well positioned to improve and accelerate our performance. Wireless mobility and nationwide broadband will be two of the most significant contributors to our growth for the next several years. That's not surprising. I mean, they should really focus on just that alone. I mean, 5G just began I believe a couple of years ago, right? And I believe it's not fully implemented yet. I'm pretty sure there's still some 4G out there, right? So, you know, once 5G gets implemented everywhere, like how 4G was when 3G just got completely like nuked, right? I think that 5G is going to be like something that they're really going to have to focus on because a lot of people are going to require it. So let's actually continue down here, and we got a lot more of like their results and all that stuff. But what I would actually like to show everybody is their consolidated statements. Now, unfortunately, this is a PDF. So I'm going to leave you guys to the webpage that allows you to get to this link because I can't link it. I cannot link it in the description because it is a PDF. But pretty much I will leave this page over here, and then you guys can go right here, download 4Q financials, and then you'll get the financials PDF so that way you guys can read it for yourselves as well. But we got over here, guys, when it comes to the total operating revenues in the 3-month ended 2021, we got 34.1 billion, and then by the same time 2022, 35.3 billion dollars. That was a pretty good increase, and it was more of an increase when it comes to the 12-month ended. Again, that was a percent change of 2.4% on the 12-month ended and 3.5% on the 3-month ended. When it comes to the total operating expenses, $26.46 billion to $28 billion. That is an increase of 5.9% on the 3-month ended when it comes to the total operating expenses. And when it comes to the net income, this went up again from 4.7 billion to 6.7 billion, increase of 41.41%. We did see this, right? We did see that they did do this. However, in the 12-month ended, they came down from 22.6 to 21.75. That is a decrease of 3.8% when it comes to that kind of net income when it comes to the 12-month ended. And of course, when it comes to their diluted earnings per share, they went from $1.11 to $1.56, which was an increase of 40.5%. However, on the 12-month ended, $5.32 to $5.06, that is a decrease of almost 5%. And now something that I actually want to take a look at when it comes to Verizon is something really, really negative. In fact, I wouldn't even say negative. This is like the worst part of this company, and even other telecommunication companies like that of like AT&T also have this issue. So this might be an industry-wide thing, but nonetheless, I still want to address it. And that is the assets and liabilities. guys, they have a ton of debt. Like Verizon has like one of the most amounts of debts out there, like of any company. I believe AT&T is more, but it's absolutely massive. Now, when it comes to total assets in 2021, you can see right here they were at $366.6 billion. In fact, they just did 666 right there. $366.6 billion in 2021, and then in 2022 they brought up this assets to $379.7 billion. That is an increase of $13.1 billion. However, let's take a look at these liabilities. I want to take a look at specifically the long-term liabilities. They went from $236.2 billion in total long-term liabilities to $237 billion in long-term liabilities. Now, the good thing, at least from what I see here, is that they went up, but they went up only $810 million as opposed to their assets going up $13.1 billion. So that's actually really, really good to see. And, you know, that might serve as like a good outlook to this company in the future, but it's still a lot of debt, guys. $237 billion in debt. That's absolutely insane. But here is some good news when it comes to this. Believe it or not, I was just scrolling down so that way I could show you guys a little bit more of this, but I came across this total debt in 2021, guys, $150.8 billion, and then in 2022, $150.6 billion. They brought it down a little bit, $200 million. Not a lot, but at least it's heading in the right direction, right? So now, guys, let's come over here into the calculator. We got the ticker symbol for VZ, market cap of $169.76 billion, with a PE of 8.79, with a current share price of $40.42. Now, this share price has been on a wild, and I mean wild, ride this past year. On the 1 year, they're down 23.68%, and they've actually gone up a little bit ever since their lowest point, but 23.68%, guys, is huge. Year to date, though, they're not that up either, only 0.75%, and most of that gain was mainly due to like the beginning of like the year or so, right? January 6th, essentially. But 52-week ranges is $32.76 to $55.51. Now, this is insane because, well, their earnings were pretty decent in my personal opinion. They went up throughout the trading day, almost 2%, 79 cents. Post-market, though, you can see that they are down 0.42%. However, I do have to show you guys something very, very interesting, and that is this story. Verizon pulls off gain from results even as analysts see weak 2023 outlook. Apparently, analysts think that they're not going to do that good in 2023, and it started off, like, I kid you not, like, this share price started off going down like 2% pre-market. Like, it was down 2% pre-market, and throughout the rest of the day it went up to 2%. So it is what it is. I'm fairly happy about it. I do own a lot of this company, so it is my worst holding, as I just showed you guys. I would not mind if this thing were to go up a little bit here and there, because yeah, it's very deep in the red for me. Nonetheless, they do pay out a dividend, a whopping dividend of $2.61, which is a yield of 6.6%, payout ratio of 48.63%, a 5-year CAGR of 2.06, so not that good when it comes to the growth rate on the dividend, but it's still a massive dividend nonetheless, with 18 consecutive years of dividend payment. Unfortunately, ex-dividend date passed as of January 9th, payout date will be on the 1st of February, and they do pay their dividends quarterly. Based off of the current shares outstanding and this $2.61, they pay out almost $11 billion, which after this is paid, in regards to their 5-year average free cash flow, they're left with $7.57 billion. Not too shabby, but you can see that when it comes to the last year's free cash flow, it is $3.4 billion. That's not good. These payout ratios are 76.44% for the last year's free cash flow, but 59.15% for the 5-year average. So just barely making it under that payout ratio of 60% for me for the 5-year average. Significantly above, though, that of the last year's free cash flow. 76%, it is very, very high. Looking at the fundamentals, we got 5 years ago in their net income of $15.5 billion to 1 year ago of $19.3 billion. That is an increase of 24%. And you can see that this company has been up and down, up and down. By the way, guys, 1 year ago is 2022 in this graphs, so just keep that in mind. 3 years ago, it was 2020. They did go down 2020, which is, again, surprising. You would think that would go up, seeing that people were stuck at home. But nonetheless, I'm gonna give this, guys, a grade of around like a 60%. They've had 2 instances where they went down, but it's still going up overall, so 60% I think is fine. When it comes to the free cash flow though, this one's looking not good. Now, we got 5 years ago of $17.7 billion, 1 year ago of $14.34 billion. That is a decrease on the free cash flow of 19% with an average of $18.5 billion. And the majority of that $18.5 billion average is coming from this 3-year value of $23.58 billion. But this is when COVID happened, so not surprising that they went up this much. But after that, it's just been downhill. So overall, I have to give this at around, like, I would say like a 30, maybe 40%. No, I'm gonna go with like a 30% because they are decreasing overall on the 5 year. So I mean, some of you guys might even say lower, honestly, and I could see that. Looking now at the revenue, however, this one's actually not doing too bad. It is increasing on the 5 year, going from $130.86 billion to $135.65 billion, as an increase of 3.66%. They did go down though during, again, I don't know why they went down during COVID. It doesn't make any sense, but they did go down in the revenue during COVID from 131.86 billion 4 years ago to 128.3 billion dollars, but they recovered the following year. So I'm gonna have to give this, I would say, at around like a 90%, right? They didn't go that low 3 years ago, and they did recover fairly nicely, and they continue to do good when it comes to the revenue. So I'm gonna go with like a 90%. In the form of total assets minus total liabilities, this one's actually doing really good. Honestly, yeah, like I did say that they have a ton of liabilities, and they do, but they do have a lot more assets. And in fact, if you take a look at these assets minus liabilities, they are very nice staircasing overall. As of today, they have $88.8 billion, which is again really, really good to see. The fact that they've always been in the positive, really, really nice. Looking at the average total assets, we get $323 billion. Looking at the average total liabilities, we get $251.2 billion. And doing this difference, we get $71.76 billion. I have to give this guys a 100%. I get that they do have a lot of liabilities, but I'm just looking at the graph, right? I'm looking at the graph, and it is a good looking graph, so I'm going to give it a 100%. Now, what I can't give a 100% is cash flow minus the liabilities, because, well, their cash flow is decreasing, for starters, and they're ramping up liabilities. So it's not surprising that their lowest point in the past 5 years was 1 year ago at negative $269.1 billion. That's a lot, guys. That's a lot. They've only had one instance where they brought this thing closer to zero. That was from 5 to 4 years ago. But that was just it, and it wasn't even that much, by around $2 billion. Average cash flow minus average total liabilities, it is negative $218 billion. Guys, I'm going to give this like a 5%. Like, that's about it. I can't give it anything more. I'm giving it 5 because of this one instance from 5 to 4 years ago. Aside from that, really, really bad. Now, what is also really, really bad, that they are diluting you. Not by a massive amount though, but dilution is still dilution. 5 years ago of 4.1 billion shares to 1 year ago of 4.2 billion shares. Increase of almost 3%. And from the previous year to the current year, there's another increase of 0.05%. Now, they're very consistent with this. Very consistent with this. So it's sad that they're increasing shares at 3%, but it is what it is. I mean, it could be a lot worse in my personal opinion. I think that they're doing this in order to not have to take on more debt, but in my personal opinion, their share price is really low. They should really begin buying back. And if they can't afford that, then I'll say it, they should definitely cut that dividend, because honestly, like, they need to save on that cash flow, guys. They really, really do. I would rather have them cut the dividend, similar to what AT&T did. Cut the dividend and buy back shares at this low price, and then reinstate that dividend back in the future. That to me is a lot safer to do than to just keep increasing that dividend. So in my personal opinion, when it comes to these shares outstanding, I'm going to give it at around like a 50%. It's not a lot, but it's still dilution. I don't like it, so 50%. And when it comes to the cash and equivalents, they currently hold $2.1 billion with an average of $5.76 billion. And when it comes to the overall grades, guys, we gave the net income a 60%, free cash flow 30%, revenue 90%, assets minus liabilities 100%, cash flow minus liabilities 5%, and the shares outstanding of 50% for an overall grade of 56%. Now you're probably looking at this and you're like, this is lower than 70%. Why do you own it, and why do you own so much of it? That doesn't make any sense. Well, guys, Verizon's a company that I bought before I learned about all of these things. So it was my noob thing, and you know, I I just don't really want to sell it because it's giving me a lot of dividends, right? $176 per quarter. And on top of that, this is the company that I use for my cell phone provider. So when I bought it originally, I was just like, I am a customer of them. I want to get something back. I didn't know anything about financial statements back then. So it is what it is. Unfortunately, I am down on it. But currently right now, I'm no longer buying it. I'm more of just riding out the wave. And then maybe in the future, I'll sell it, depending if or not their fundamentals get better. And now let's figure out if at the current share price of $40.42, this is looking like a buy. Now, revenue growth, guys, I'm going to say 1, 2, and 3%, mainly because the revenue forward is estimated at 2.62. So I went 1, 2, and 3. That's about it, right? I went low, median, and then high. And I believe high should be at around like 3%. Now for the shares outstanding, I went -3, -2, and -1. The negative just means that they're issuing. So with the lowest assumption, I'm going to say that they're going to continue issuing shares at -3%, or sorry, at 3%. And the best one, that they'll continue to issue shares, but at a lower rate at 1%. Now, unfortunately, because they have so much debt, guys, all of the target share prices after debt, they're negative. So ignore these ones. The target share price is not adjusting for debt. It is $23.44 to $25.66. And the current share price of $40.42, this is looking very, very expensive. And now looking at the dividend, this is, by the way, what attracts a lot of people, but be very, very careful with it. Putting in a monthly income of $5,725, you get an annual dividends of almost $370. Insane. Quarterly of $92.42 and a monthly of $30.81. Now, remember why I said careful? Because I did say that they are issuing shares and their cash flow is going down. And on top of that, remember that the average 5-year free cash flow, it is under 60, but their last year's free cash flow, it is 76.44. Very, very high in my personal opinion. And you might get the risk of this dividend being cut. If it does get cut, get ready for the share price to fall, because I think the only reason why this thing hasn't fallen more is because people like this dividend, and Verizon knows that. So either they cut it, people leave, they keep it the same and don't increase it, they lose that status of continuously increasing a dividend, or they continue to increase it and throwing gasoline onto this fire that they probably won't be able to issue this dividend in the future. So essentially kicking the can down the road. Those are the three options when it comes to dividend. In my personal opinion, do not buy this company solely for its dividend. You gotta have some good prospects. At least for me, the way that I see Verizon, I think that they're the main leader when it comes to 5G, right? It's like them, T-Mobile, and AT&T. I think that they're number one, and I would like to be invested in the 5G space. I'm not saying that they'll be the ones to win, but I personally like that idea, so that's the reason why I am invested in them. Overall, Verizon, not too shabby. Hopefully, their fundamentals get better in the future. So with that said, let's now move on to... Alright guys, now let's move on to the third company, and that is none other than Johnson & Johnson, the dividend titan. And yeah, this company had earnings, so let's actually see what we got over here. Coming over here, guys, into Seeking Alpha's earnings summary, we got EPS normalized actual came in at $2.35, beat by 11 cents. EPS gap $1.33, missed by 54 cents, and revenue actual came in at $23.71 billion, which was a miss by almost $195 million. So now let's jump into their actual earnings report, because you can clearly see that they didn't do that good in comparison to what analysts were expecting. So we got here, guys, 2022 fourth quarter reported sales decline of 4.4% to $23.7 billion, primarily driven by unfavorable foreign exchange and reduced COVID-19 vaccine sales versus the prior year. That's a perfectly logical statement. Obviously, a lot less people are getting COVID. It's not as much as before, so that's not surprising. And the fact of the matter is that because of inflation, yeah, foreign exchange, that probably also reduced their sales as well. Operational growth excluding COVID-19 vaccines of 4.6%. 2022 fourth quarter earnings per share $1.33, decrease of almost 25%. That is absolutely insane. And an adjusted EPS of $2.35, which was an increase by 10.3%. Okay, so clearly one went down 25 and then the other one went up by 10.3. Yeah, that's not really that good, guys. It's still overall a net negative when it comes to these EPSs. And then 2022 full year reported sales growth of 1.3%. to $94.9 billion, primarily driven by strong commercial execution, partially offset by unfavorable foreign exchange, similar to what we saw up there. Operational growth of 6.1%. 2022 full-year earnings per share of $6.73 decreased by 13.8%, and adjusted EPS of $10.15 increased by 3.6%. Company guides 2023 adjusted operational sales growth excluding COVID-19 vaccines of 4% and adjusted operational EPS of $10.50, reflecting growth of 3.5%. So even without the COVID-19 vaccine, guys, they still believe that they will increase their EPS to $10.50 as opposed to what it was at $10.15. Now, looking at over here, the CEO's comment, we got Johnson & Johnson today announced results for the fourth quarter full year 2022. Our full year 2022 results reflects the continued strength and stability of our three business segments despite macroeconomic challenges, said Joaquin Duato. I don't really know how to say his name. Chairman and Board and Chief Executive Officer. I am inspired by our employees who make a difference in the health and lives of people around the world every day. As we look ahead to 2023, Johnson & Johnson is well positioned to drive near-term growth while also investing strategically to deliver long-term value. Still though, they did not do that good, guys, when it comes to their earnings overall. Let's come over here to the overall financial results. We got reported sales 2021 24.8 billion to 2022 of 23.71 billion. That's a decrease of 4%. Looking at net earnings, 4.74 billion to 3.52 billion. That is a decrease of 25.7. That's a massive decrease. And then EPS diluted $1.77 to $1.33. as a decrease of 25%. And when it comes into the full year, we went from 93.77 billion to 94.94 billion. That is an increase of 1.3%. In regards to the net earnings, we went from 21 billion almost to 17.9. So let's bring it up to 18. So 21 billion to 18 billion. That's a decrease of 14.1%. And in the EPS, $7.81 to $6.73, decrease of almost 14%. Looking at the regional sales results, 2021, guys, $12.16 billion, and then in 2022, $12.52 billion. By the way, this is for the US. So for the US, they went from 12.16 billion to 12.5 billion. That is an increase of 2.9% reported and then adjusted 2.7. Internationally, they actually went down 12.64 billion to 11.2 billion. That's a decrease of 11.5%. And worldwide, they went from 24.8 billion to 23.71 billion, decrease of 4.4%. When it comes into their segment sales results, we got Consumer Health 2021, 3.7 billion to 2022, a 3.77 billion, increase of 1%. Pharmaceuticals, 14.2 to 13.2, that is a decrease of 7.4. MedTech, 6.86 to 6.77, that is a decrease of 1.2%. Worldwide, $24.8 billion to $23.71 billion, that's a decrease of 4.4%. And when it comes to their 2023 guidance, we can see that adjusted operational sales are expected between 3.5 to 4.5% with a median of 4%. In the operational sales, we got a 4.5 to 5.5 with a median of 5%. An estimated reported sales from 4.5 to 5.5, once again a median of 5. Adjusted operational EPS 2.5% to 4.5%. By the way, this was $10.40 to $10.60. And adjusted EPS diluted, we got $10.45 to $10.65 with $10.55 in the middle. 3% to 5%, 4% in the middle. So now let's hop into the calculator. We got the ticker symbol for J&J, market cap of $440 billion. A PE of 23.43 with a current share price of $168.31. This on the 1 year is up 3.28%. Year to date, however, it's actually down 5.54%. That was actually really unexpected. I was not expecting it to be like that. Most companies are up on the year to date. 52-week range, it is $155.72 to $180.69. And as you can clearly see, guys, on the trading day, they went nowhere. And post-market, they're only down 0.2%. They do pay out a whopping dividend of $4.52, which is a yield of 2.7%, payout ratio of 44.06, a 5-year CAGR of 6.03, with 60 consecutive years of dividend payment. They are the OG, or at least one of the OGs of Dividend Kings. By the way, guys, Dividend Kings are companies that have paid out dividends for 50 or more years. Dividend day is actually coming up on the 17th of February. Payout day is on March 7th, and they do pay their dividends quarterly. Based off of the current shares outstanding, they pay out $11.83 billion, and after this is paid, they're still left with $7.41 billion, and as of their last year's free cash flow, it is $8 billion. These payout ratios are 59.87% for the last year's free cash flow and 61.5% for their 5-year average. Looking at the fundamentals though, we got net income 5 years ago 1.3 billion to 1 year ago of $20.87 billion. Now, before we actually go on, guys, they end their fiscal year in January. So this 1 year ago that we're seeing right here, it is taken from January of 2022, so it does not encompass the entirety of 2022. It's literally just the end of 2021. That's all that is. So just keep that in mind. That is an overall increase, guys, of 1,506%. And you can see massive jump from 5 to 4 years ago, consistent decrease from 4 to 2 years ago, and then a massive jump 1 year ago. So for that reason, I'm going to have to give this, guys, an overall grade of like 40%. Looking now at the free cash flow, this one's a little bit different. 5 years ago of 17.77 billion to 1 year ago of 19.76 billion. Increase of 11% with an average of $19 billion. Consistent increase from 5 to 2 years ago, and then slight decrease from 2 to 1 year ago. So overall, I'm gonna have to give this at around like a 65%, mainly because they did go down from 2 to 1 year ago. Actually, you know what? No, I'm actually going to change this to like 70%, just because, I mean, it wasn't that much of a decrease from 2 to 1 year ago, and overall they are up. Looking now at the revenue, consistent increase from 5 years ago of 76.45 billion to 1 year ago of 93.77 billion, increase of 22.66%. They did go down, actually no, they did not go down. I am so terribly sorry. They were actually consistently increasing from 5 to essentially 1 year ago. A little bit of a jump of like $10 billion from 2 years ago to 1 year ago. So I'm actually going to give this one overall grade of like 95%. Assets minus liabilities, this was looking really good. Unfortunately, this one is not consistently increasing. From 5 to 3 years ago, it did go down slightly, but then they brought it back up. Overall, they are still up on the 5 year in the positive, which is really good. As of today, they're up to $74.6 billion. Average total assets is $168.5 billion. Average liabilities is $102.3 billion. Doing this difference, we get $66.2 billion. I'm going to give this, guys, a 60%. Cash flow minus the liabilities, this one, unfortunately, is not as good as I would like it. They did have instances where they did bring it up, for example, from 5 to 4 years ago and from 2 to 1 year ago. But overall, the trend line is to go decreasing. The lowest point was 2 years ago, though, at negative $91.4 billion. As of 1 year ago, it is negative $88 billion. Average cash flow minus the average total liabilities, we get negative $82.41 billion. I'm going to give this at around like a 45%. Looking now at the shares outstanding, they are buying back shares at a pretty decent rate. 5 years ago of 2.68 billion shares to today of 2.6 billion shares. That's a decrease of 2.45%. And from the previous year to the current year, that is another decrease of almost 0.5%. And in fact, they have never issued shares, guys, which is again really good. Even when COVID hit from 3 to 2 years ago, they kept it the same. Now, if they keep it the same or buy it back, to me, it is a win. So overall, I'm gonna have to give this a 100%. And when it comes to the cash and equivalents, they currently hold $11.35 billion with an average of $15.5 billion. These grades come out to be 40% for the net income, free cash flow 70%, revenue 95%, assets minus liabilities 60%, cash flow minus liabilities 45%, and shares outstanding of 100% for an overall grade of 70%. Just passed. I think this is fairly good in my personal opinion. Johnson & Johnson is a major company. The bigger they are, guys, the harder it is for them to grow. So not surprising to see these kinds of numbers when it comes to these profit metrics. So now figuring out if at the current share price of $168.31, it is a buy, I'm going to put, guys, the revenue growth of 4, 5, and 6%. According to Seeking Alpha, their forward is estimated at 5.77. So I went 4, 5, and 6%. For the projected share buyback, I'm going to go 1, 2, and 3%. This puts me with a target share price, not adjusting for debt, of $157.07 to $171.73. And adjusting for debt, this shoots up massively. They don't have any debt. in accordance to their cash and equivalents. This is now $318.52 to $347.93, with a margin of safety of 5 to 50%. This puts me between $270.75 to $330.54. So not adjusting for debt, this is actually looking like a buy in some instances, even for the medium and high assumption. Not so much for the low assumption, and then adjusting for debt, guys, it just, yeah, it's just an all-out buy. So it really just depends as to what you want to believe, but these are my numbers, these are my assumptions, and in my personal opinion, Johnson & Johnson right now is actually not that bad of a company to buy at the current moment from what I'm looking at with these fundamentals. And looking at the dividend when it comes to Johnson & Johnson, putting in $5,725, this gives you guys an annual dividends of $153.75. They are a dividend king. They have been giving out this dividend for several decades now, so I would argue that this dividend is pretty safe in my personal opinion. And of course, let me remind everybody as well, when it comes to healthcare companies, make sure that you take a look at their pipeline when it comes to drugs. You want to see what drugs they actually have in which stage and which current ones are going out of patent, because that does affect their revenue in the future. So just keep that in mind when analyzing Johnson & Johnson. And for the last company that I would like to take a look at, guys, this evening would be none other than Union Pacific. So let's come over here to the earnings summary. We can see that they did not do too hot. EPS normalized actual came in at $2.67, missed by 10 cents. EPS GAAP actual, same thing, $2.67, missed by 11 cents. Revenue came in at $6.2 billion, which was a miss by $77.71 million. Now coming over here to the actual earnings report, unfortunately, this one is another PDF, but it kind of is a PDF. I will just have the web page that you could just click and then just this page will pop up. So just keep that in mind. But nonetheless, Union Pacific reports fourth quarter and full year 2022 results. Fourth quarter earnings diluted per share $2.67. Fourth quarter operating revenue up 8%. Full year earnings per diluted share $11.21. Full year operating income up 6%. And it goes on to read, Union Pacific Corporation today reported 2022 fourth quarter net income of $1.6 billion or $2.67 per diluted share. This compares to 2021 fourth quarter net income of $1.7 billion or $2.66 per diluted share. Reported net income for the full year of 2022 was $7 billion or $11.21 per diluted share. This full year results compared to full year 2021 net income of $6.5 billion or $9.95 per diluted share. Now we got here the statement from the CEO. We got in the fourth quarter, we grew car loads as we continued to face challenges hiring craft professionals and critical locations and experienced the impact of extreme winter weathers in our network in December. Boy, was that true, especially in the Midwest, said Lance Fritz, Union Pacific Chairman, President, and Chief Executive Officer. As a result, revenue growth was more than offset by elevated operating expenses from operational inefficiencies and a higher inflationary environment. So basically, the revenue came in really bad, but just because everything just went up in price due to like inflation and inefficiencies, this kind of offset that decline in what it should have been in their revenue. That's pretty much what that's saying. For the full year, we made good progress on employee safety and we took another step toward our sustainable goals as our fuel consumption rate improved for the fourth consecutive year. Looking to 2023, we expect to continue improvements in network fluidity to support business development, generating volume growth that exceeds industrial production. We also expect network improvements to help us recapture lost productivity while providing customers with reliable services. So they're saying that like they really struggled, and honestly, they're not that confident when it comes to 2023. This was pretty much nothing like when it came to like these last couple sentences over here. We're trying to be optimistic, but in reality, not really. And in fact, we see this over here on the fourth quarter summary. Financial results, revenue growth offset by higher expenses associated with inflation, network recovery. Fourth quarter record for operating revenue, fourth quarter 2022 compared to fourth quarter 2021. Operating revenue, $6.2 billion, was up 8%, driven by a higher fuel surcharge revenue, core pricing gains, and volume growth, partially offset by negative business mix. Business volumes as measured by total revenue, car loads were up 1%. Union Pacific's 61% operating ratio deteriorated 360 basis points falling fuel prices late in the quarter positively impacted the operating ratio by 20 basis points. Operating income of $2.4 billion declined 1%. The company repurchased 3.5 million shares in the fourth quarter 2022 at an aggregate cost of $0.7 billion. And now I actually want to come over here and take a look at their guidance. Full year car loads to exceed industrial production. Current industrial production forecast negative 0.5%. Full year operating ratio improvement, pricing dollars in excess of inflation dollars, capital allocation, capital spending less than 15% of revenue, capital plan of $3.6 billion, long-term dividend payout target 45%. Ooh, that's actually really good. Great. Excess cash to share repurchases. I like that. Honestly, like these last two are really solid, but the overall year guidance is honestly, I like it. It's pretty attainable in my personal opinion. And let's just see a couple of these numbers. We got over here the operating total revenues. 2021 fourth quarter 5.7 billion to 2022 of 6.2 billion. That is an increase of 8%. When it comes to the net income, 1.7 billion to 1.64 billion, decrease of 4%. In regards to the shares and per share kind of measurements, earnings per share went to 267 in 2021 to $2.67 in 2022, so no change. In 2021, $2.66 to $2.67. That was per the earnings per share in diluted, so that was a slight increase by a penny. And dividends declared per share in 2021 was $1.18, and they brought it up, guys, to $1.30. Really nice. So now coming into the calculator, we got the ticker symbol for UMP, market cap of $125 billion and a PE of 18.12 with a current share price of $203.18. This in the 1 year, guys, it is down 17.1%. Year to date, it is also down 2.12%. 52-week ranges is $183.48 to $279. And in fact, just today alone, you can see that when their earnings came out, guys, they fell 3.31%, almost $7, and even post-market 0.58%, $1.17. Not 52-week lows when it comes to this range, guys, but with this current fall and the fact that they are close to this 52-week low, this might actually serve as a pretty good buying price, not gonna lie. Now, they do pay out a dividend of $5.20, which is a pretty good yield at 2.5%, a 5-year CAGR of 15.42% with 16 consecutive years of dividend payment. Ex-dividend date passed as of December 16th. Payout date was on the 29th of December, and they do pay their dividends quarterly. Based off of the current shares outstanding, guys, they pay out almost $3.2 billion in dividends every single year. And after we subtract this from the 5-year average free cash flow, they're still left with $2.4 billion. And as of their last year's free cash flow, if we do the same math, we get $2.56 billion. These payout ratios are cutting it close, though, still under that 60%. For the last year's free cash flow of 55.5% and for the 5-year average at 57.2%. Looking now into some fundamentals, net income 5 years ago of $5.96 billion to 1 year ago of $6.99 billion, let's just say $7 billion, as an increase of 17%. Really good consistent increase overall. Dipped during COVID, which by the way, 3 years ago, this is COVID, guys. 1 year ago is 2022, 2 years ago is 2021. And 3 years ago, it is 2020. So just keep that in mind. Overall, because this is a very nice consistent increase overall, the one dip was because of COVID, I'm going to give it a 100%. Looking now at the free cash flow. Unfortunately, not as good as the net income. 5 years ago of $5.25 billion to 1 year ago of $5.74 billion, increase of 9% with an average of $5.57 billion. Now, they did go down from 5 to 4, brought it up during COVID from 4 to 3. Then they brought it back up again from 3 to 2, and then they brought it down from 2 to 1. That's why I'm giving it, guys, a 75%. Overall, they are going up, but it is not that consistent in my personal opinion, so I think a 75 it is fairly given. In the revenue, we see something even worse, and that is that from 5 years ago, they did $22.8 billion to 1 year ago of $24.8 billion, increase of almost 9%. Now, I gave this a 75% because sure, they did go down during COVID, and if that was the only one, I wouldn't really mind it. But they were going down from 5 to 4 years ago, right? And then COVID just was their bottom, and then they went back up. That's essentially why I'm giving a 75%, because this right here, this kind of consistent decrease is a little bit concerning, even though one of them was COVID related. The fact of the matter is that they were still going down. Now, I'm giving it a 75, barely passing, because they continued to go up pretty consistently from 3 to 2 to 1 year ago. In their assets minus liabilities, however, this one's looking awful. Consistent decrease across the board, and their lowest point was as of 1 year ago and today at $12.16 billion. Now, the good thing is that they are still in the positive, but consistent decrease is not something I like to see. Average total assets, it is $63.7 billion. Average liabilities is almost $49 billion. Doing this difference, we get $14.7 billion. I have to give this a 10%. And actually, I'm taking this back a little bit. I'm going to give this like a 25%. The main reason is they're going down consistently. I don't like that. I'm not going to give it a 10%, change my mind, because they're not in the negative, which is really, really good. However, what is looking atrocious, and that is their cash flow minus liabilities. Every single year, they have brought this down. As of 1 year ago, they're at negative $47.5 billion. Average cash flow minus the average total liabilities, negative $40.5 billion. Again, every single year getting deeper and deeper into the red. Not good. Not 1 year did they bring it up slightly. That's why I'm giving this a 0%. What is looking amazing though is these shares outstanding. They're not diluting you at all. 5 years ago of 725 million shares to today of 612.7 million shares. Decrease on the 5 year of 15.5%, and from the previous to the current year, so again 2 years ago, 638.8 million to 1 year ago of 612.7 million, increase of a little bit more than 4%. And on top of that, not a single year did they issue shares. That's why I'm giving it a 100%. And lastly, when it comes to the cash equivalents, they currently hold $973 million with an average of $1.1 billion. Looking over the overall grades, we gave them the income of 100%, free cash flow 75%, revenue 75%, assets minus liabilities 25%, cash flow minus liabilities 0%, shares outstanding at 100%, for an overall grade of 71%. Yeah, I kind of see this as well. Railroad companies are very, very niche, right? When it comes to them, there really isn't that much competition, but they really are a good defensive overall industry. So 71%, I see it very, very good when it comes to this. And now to determine if after all of that drop, specifically today, do we buy this company? Let's put the revenue growth, guys, at 8, 10, and 12%, and the projected share buyback of the same. Now, the projected share buyback we know because we have just saw it. However, when it comes to the revenue growth, we can see that the forward is estimated at 9%. So I decided to put it at 8, 10, and 12. So that way it covers all ranges as much as possible. Doing so, we get the target share prices of $184 to $219.08. Not adjusting for debt, and adjusting for debt, unfortunately, this comes down to $126.24 to $158.88, with a margin of safety of 5, 10, and 50%. This puts me between $107.31 to $151. As it currently stands, not adjusting for debt, this is looking like a pretty good buy in between the low and median assumption. However, adjusting for debt, it would need to fall around $60 or so for this to actually fall into place. But nonetheless, not adjusting for debt, this is still looking like a pretty decent buy. And now lastly, looking at this dividend, if we put in $5,725, this nets us $146.53 in annual dividends per share. And on top of that, it does seem that they are able to keep this dividend going, especially seeing that their payout ratios are less than 60%. So overall, when it comes to Union Pacific, I like this company, I own this company, and I might actually be buying into this company a lot at the current moment because they have fallen a significant amount. I would like to buy them sub 200, but at 203, 202, I think it's really good to start dollar cost averaging down. And that pretty much does it for the earnings, guys, for Tuesday. I'm going to end this right now because I have a headache, my throat's starting to hurt, and I still need to edit this thing. I don't know if I'm going to be able to put it out on the same day as these earnings. If you see it on the same day and it's late, I'm so terribly sorry. If you see it the following day in the morning, then it is what it is, right? But hopefully everybody liked it. Liked if you like, comment, subscribe. It really does help with the algorithm on YouTube. You guys can follow us on the NewTek sites, link in the description below. So with that said, peace out, and I will see you all in the next stock analysis video as well as earnings report.